Learning Objective 17-7 is to make calculations and record journal entries for the general fund. And we previously said there are 4 steps here: appropriation, encumbrance, expenditure, and disbursement. Not all of them are going to have encumbrance. Encumbrance would only be for large dollar items with delay. Those would be the only items that are going to have an encumbrance. Otherwise, they would not. So by appropriation, this would be when the budget would be a budgeted expenditure. Now, as the budget says that you can spend this money, because you can't spend anything without authorization, without that appropriation. In the example here, we go to expenditures template, and Barb City issues a purchase order on February 1st. Well, the appropriation we already did in the budget. So the next thing that we're going to do is we'll do the encumbrance. And let's talk first about what an encumbrance is. Encumbrance, again, is a reservation of a budgetary appropriation. And it's recognized when you make an order. And it would usually be a large item, and it would be some kind of delay. If you're just going to issue a purchase order and they're going to show up with the item 2 days later, that doesn't justify an encumbrance. Likewise, if it's a small amount, again, not an encumbrance. It's got to be a large amount, usually a big delay. And ensures that the company, the government doesn't accidentally spend money that it meant to spend on this other item. So they don't forget about this big item. And it provides a control over administrators that they don't accidentally expend too much money, because that would be a disaster. So when they make an order, if it's for a large item and there's a delay, then they're going to record something called an appropriation. They're going to record something called an encumbrance. And the way that this would look is you would debit the account encumbrances. It's going to be capitalized because it's a budgetary account. And you're going to credit budgetary fund balance assigned for encumbrance. And I just abbreviate fund balance FB. Like so. It would be for the amount of the purchase order. The next step now would be the actual expenditure. And this would be when you receive the goods or services that you had ordered in step 2. And the first thing you're going to do is you're going to reverse your encumbrance, and then you're going to record the expenditure. So we undo this encumbrance here by debiting budgetary fund balance assigned for encumbrance, $15,000. And we credit, usually the reversal is for exactly the same amount. And in this particular situation, it's interesting because the goods only cost $14,000. So the purchase order was based on an estimated price. The price turned out to be lower. So we're going to reverse what we originally did in the encumbrance of $15,000, and now we're going to record an expenditure of $14,000. So whatever the item is, we don't know. It's some kind of good, so I'm just going to debit expenditures and credit vouchers payable, which is a liability. Now let me explain a little bit about what vouchers payable is. Vouchers payable, companies used to do this, they don't do it anymore, but governments still do it, is they keep all the items related to this expenditure together. So there'll usually be a folder with a lot of forms and a binder clip over it and a big envelope. And the more paperwork that comes about, they all stick it in the folder, and it all stays together in one big pile. And that pile is called a voucher. And there'll usually be some kind of cover sheet explaining all the steps that the voucher needs to go through to get approved, from the appropriation, perhaps, through the encumbrance, the budgetary fund balance, and all the different people who need to sign off on it under different circumstances, and so on and so forth. And the voucher is going to stay together until they make the payment. So this becomes a vouchers payable, and somewhere in the office, someone has a great big file cabinet full of vouchers payable, and then when they're ready to pay things, they'll pull it out of that file cabinet, insert some kind of payment order, they'll draft a check, add the check to the voucher, and they'll put it through all the people who have to sign it. So this way, whoever signs the check will also receive the whole voucher, They can look through the voucher to make sure that to see what the money is for and make sure that all the approvals were in place. So that's what vouchers payable is, and governments use the term vouchers payable rather than accounts payable. The final step is disbursement, and this would be you've set up an expenditure and a corresponding liability, and now you're actually going to pay off the liability. So what you're going to do is, there you go, disbursement. So what you're going to do is, in your books, you'll debit vouchers payable for $14,000, the amount that you owe, and credit cash for $14,000. And that's how you would pay for the goods. There's a weird quirk in government accounting and government operations in general, and that is that when there's an encumbrance outstanding that's not delivered and received by the end of the year, oftentimes the government is no longer obligated to honor it. So basically the budget year is over and that's it. So we were going to buy this for 2019. 2019 is over, you haven't delivered the goods, and so we don't have to pay it. So governments usually do honor these things, but there's a little technicality that says they really don't have to do it. Anyway, the encumbrance, the accounting for the encumbrance is a big controversy, and there are two ways of doing this. The GASB has never explained how to, but we have the idea that option one would be encumbrances lapse, or encumbrances do not lapse. Let me explain each way of thinking here. With lapsing encumbrances, at year end you close out all your encumbrances and you put them into an assigned fund balance instead. And that indicates that the money has been set aside. And the beginning of next year, you're going to set up a new encumbrance, assuming that you intend to honor it. There's an alternative approach, and that is called encumbrances that do not lapse. And what you would do is you would close your encumbrances to assigned fund balance, but next year you're not going to set up a new encumbrance. But rather, whenever you receive the goods, eventually you'll just receive the goods. Under option two, you would have this fund balance assigned, which needs to be adjusted at the end of the year. So let me show you how this is going to work in a practical example. Let's assume that they lapse. When you first make the purchase, you would debit budgetary fund balance assigned for encumbrances and credit encumbrances. That's just the standard journal entry. And then at the end of the year, we would reserve. At the end of the year, we would reserve that. We would reverse not reserve. We would reverse that entry as it's shown over here. So when you make the purchase, I think I said that wrong. When you make the purchase, you debit encumbrances and you credit budgetary fund balance assigned for encumbrances. Then, when you reverse this at year end, which in this case is June 30th, and you create a fund balance assigned for encumbrances. That's different from a budgetary fund balance. These are budgetary accounts. Now it's going into the real account. So you would debit fund balance assigned, $15,000 unassigned, and put it into fund balance assigned for encumbrances. And this sets aside the $15,000 in your fund balance as kind of like a little indicator, a sign that this $15,000 shouldn't be spent. At the beginning of the next year, if they lapse, you're going to put it back into unassigned, and that's kind of the lapse. So you've taken the $15,000 out, and you've put them into fund balance unassigned all over again. This reverses the year-end entry, and then you record a brand new encumbrance. When you eventually receive the goods, you're going to reverse that brand new encumbrance, spend the money, and you're going to close out the expenditures to fund balance unassigned, just like any other expenditures. Now, if outstanding encumbrances don't lapse at year end, again, what you're going to do here is you're going to reverse your initial encumbrance, and you're going to you're going to set aside a fund balance assigned for encumbrances, and then you're just going to leave it alone. So the encumbrance is no longer on the books, but you have a fund balance assigned for encumbrances, so you still do have something on your balance sheet. At the beginning of the next year, you're going to reclassify this from fund balance assigned for encumbrances to fund balance assigned for encumbrances, and you're going to insert the year, in this case 2021. In this case 2021. So this way, there's still a fund balance assigned for encumbrances. Over here, it would show up on your balance sheet in your books, or rather general ledger, as budgetary fund balance assigned for encumbrances. But here it would show as your fund balance assigned for encumbrances 2021. Your expenditures are debit expenditures, credit vouchers payable. And then here, when you close your expenditures account, you're going to debit fund balance assigned for encumbrances, credit expenditures 2011 for whatever it was, and put the other $1,000 into fund balance unassigned. So eventually everything kind of adds up after 2 years, but they follow two different paths. There's two approaches for inventory, what's called the purchase method and the consumption method. And the truth is there used to be two methods for like all of financial accounting. I think today we don't really teach this anymore, the difference between these. But the purchase method and the consumption method. The purchase method recognizes the whole expenditure for inventory in the period the supplies are acquired. And the acquisition of inventory is treated as an outflow of resources, whereas under the consumption method, we recognize expenditures only for the amount of inventory used. And the use of inventory is treated as an outflow. So with purchase method, it's more like cash flow. And consumption method, it's more like accrual. And government uses both methods. My experience with governments is more they use the purchase method. And what happens is that's how they keep the books, but then they're going to adjust it when they prepare the balance sheet anyway. And let's go into an example of it. So for the purchase method, when the government buys inventory, it's going to debit expenditures for $2,000 in this case, and it's going to credit vouchers payable. And there isn't going to be an encumbrance here because it's a relatively small amount. And then when they recognize ending inventory, so they would just immediately write it all off as an expenditure. And then they count up the inventory at the end of the year, and they see there's $1,400 there. So they're going to debit inventory of supplies for $1,400. And they're going to credit fund balance non-spendable for $1,400 because you can't spend supplies. And let's say the following year there is only $500 worth of inventory left. Then they would debit fund balance non-spendable. They'd reverse this and credit inventory of supplies by not by 1,400, sorry, by 1,400 minus 500 because they've used up $900 worth of supplies. So the purchase method focuses on how much was expended. The consumption method, let's say they bought $2,000. It's going to be the same debit expenditures, credit vouchers payable for $2,000. And then they're going to recognize at June 30th, they're going to recognize ending inventory like so. They'll debit ending inventory for $1,400. And they're going to credit expenditures also for $1,400. as opposed to fund balance non-spendable. And then they're going to set up the right amount, fund balance non-spendable, for $1,400 because there's $1,400 on the balance sheet that can't be spent. And then the debit would be fund balance unassigned for $1,400. And that again marks off that $1,400 of the fund balance can't be spent. And let's say the value of inventory goes down. Then what you would do is you would debit expenditures. It goes down by $900. So that would mean that you use $900 worth. So debit expenditures and credit inventory of supplies for $900. And then you would also take $900 out of non-spendable and put it into unassigned. So debit fund balance non-spendable for $900 and credit fund balance unassigned for $900. So the net effect of these is the same. The one difference is whether you're recording these expenditures. So this here is going to take the $900 back out of expenditures, whereas this is just going to take them out of fund balance.